Hello, everyone, and welcome to tonight's session of TradeFinder Live. My name is Zach. I'll be facilitating this session tonight with our speaker, Rob Roy. I'm here to facilitate the session. I'm aware we're not here to listen to me, so after we get through some housekeeping items, I'll be out of the way and introduce Rob. First and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, whether it might be a TradeFinder or insiders meeting, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website to be read in full detail there, and you feel free to take a screenshot if you like, but that's the main point to take away. So for this session, we have a brief question portion at the very end. Rob will go through his presentation, look through some case study considerations, and then open it up to a few questions from both Zoom and YouTube. So as you'll see on the screen, there's actually only one method for asking questions for this session, and that's going to be the Q&A window. At any point throughout the session, please feel encouraged to utilize that method. And just again, know that it is brief at the end. We pass through as many as we can, allowing time. But if we don't get to your question, just know it has nothing to do with the validity. We just only have that hour-long session, and also take that as encouragement if we don't get to your question to attend the insiders meeting when there's a 45-minute session solely based on questions. So much higher likelihood of getting your question addressed there if we don't get to it this evening. Lastly, we have the chat window as well. That can be for interaction amongst all attendees, and any support related queries I'll be happy to handle there. Just know that Rob can only take questions from the Q&A window. So if you would like it to be possibly addressed, be sure to leave it there. I believe that covers off all the important details. So at this moment in time, we'll get started, and I'll introduce Rob Roy.
Hi, everybody. Welcome to TradeFinder Live. For those of you that are joining us from one of our live stream services, welcome to you. Those of you that have been here with all of our normal viewing, welcome to you as well. For our longtime subscribers is what I'm trying to say. I have a humorous story to tell you. When I used to do live seminars, when I would first start the seminar, there was always just this tension-filled room. So I kind of always started off with a joke just to try to lighten the mood, get the energy up, get it going, etc. So I'm not going to tell you a joke, but I am going to tell you what I think is a humorous story. Last night I was at the gym and I was working out on one of the machines, and there was a lady working out on another machine, and I was looking at her and it's like, man, she sure looks like, and so I was looking at her a little bit. She looked back at me, and I didn't know if she was thinking that I was this, this creepy guy or whatever. And so when I left the machine, it just happened that our paths crossed. So I had to just mentioned to her, I said, has anybody ever told you look like Jennifer Lopez? And she goes, I hear it all the time. She goes, anybody ever told you look like Chuck Norris? I said, I hear that all the time. So we had a good chuckle and we did a little fist bump, and then I moved on. So, and everybody I've told that story to is like, you saw somebody look like Jennifer Lopez and you just walked away. But anyway, you're in the gym, so try to respect people's privacy. But I thought that was a humorous story. Hopefully that gave you a little bit of a chuckle. We always get the Chuck Norris comments, as you know. I had my hat on stuff, so a little bit more like Chuck Norris. All right, so with TradeFinder, for those of you that are new, we will talk about the markets, not just the U.S. market, but international markets as well. And then we'll do a review of any case study considerations, case studies that we may have closed for our alert subscribers. I'll explain the difference between the two to you, and then we'll look for a case study consideration for tonight. And as Zach said, with whatever time's left at the end, we'll open that up to a general Q&A, and we'll try to get to as many questions as you can, or as we can. And so with that, let's go ahead and take a look at, I just wanted to make sure that y'all were seeing my screen. All right, so here's the market bounce. And as you know from our weekend update, that we were looking for a bit of a bounce. So we have satisfied the first factor in a bounce, meaning that we have recovered the 10-day moving average. Because if I were to walk this back, we're back to the 12th of May, you can see that we were oversold from the 10-day moving average. So now we fixed that problem, but you've heard me talking about this a lot lately with the fact that we have significant separation between the 10 and the 50-day moving average. And I think that gets resolved on this move. And the 50-day will continue lower. And if we continue this rally to the upside, the 10-day will continue up. Perhaps they merge right here at 420. That makes a lot of sense. The market's going to have a hard time getting back above 420, but I think it has a pretty free run up till then. I'm not saying tomorrow is going to be up, the next day is going to be up. but I feel like we hit 420 out of this bounce before we figure out if anything else happens. And where the 10-day moving average is to the 50-day will determine whether or not we break that and go up and set this wave 4 somewhere above 420. So it does matter how quickly we get to 420. The sooner we get to 420, the more likelihood is that we go above 420. The longer it takes us to get to 420, the less likelihood there is that we break that. I hope that makes sense. But that's basically how it works with this 10-50-day moving average gap. So I feel like we have more to the upside. How much more depends on how fast we can move. The markets are pretty oversold. I was watching the financial networks today, as I do every day, and they're talking about outflows. Money's moving out of equity funds. That's usually a pretty positive sign for the market because the retail public's usually wrong. And so when the retail public's running for the hills, that's when things usually turn and the market moves back to the upside. I am in no way saying that the bottom is in. I don't believe the bottom is in. The charts don't show that the bottom is in, but everything seems to be pointing towards some sort of a relief rally at this point in time before perhaps we turn and head back lower from there. So I wanted to share that with you as far as the speed of which we get to 420 really matters. All right, let's look at interest rates. The TNX back to the upside a little bit today. So not a lot of reprieve on the 10-day. So here's 3% right there. And look what we did on the high. We hit 3%. So tomorrow is going to be key. Do we move back above 3%? I don't know if the market is going to like that too much. If we can consolidate through here, I think the market would like that a little bit better. There's separation between the 10 and the 50-day moving average on the 10-year as well, not as significant as it is on the SPY, but it's still there. So we'll see if that gap needs to close a little bit. And then I wanted to show you the dollar, because the dollar is giving a little bit of a break to international companies. Now you would think with this move back to the downside in the dollar that would be helping metals. Well, when I show you the chart of gold here in a second with the GLD, you're like, why didn't gold bounce today? Why weren't the metals stronger today? It's pretty interesting that they weren't, but broke below the 10-day moving average on the dollar. And you know my feelings of the dollar. I still want a strong dollar. I didn't like it getting this strong because it's too restraining on profits from international companies due to the currency exchange rate at a time when things are tough enough on all companies trying to do business right now. So a little bit of a reprieve in the dollar is okay. I just don't want to see the dollar tank or collapse. But we talked about this. The dollar was overbought. There's separation between the 10 and the 50-day moving average there. We were due for a bit of a pullback in the dollar. Let the 10-day moving average come back down. Now, these two are very similar. In other words, the separation with the dollar to the upside, with the S&P to the downside. And so it would make a lot of sense that if the dollar comes back down and the 10-day moving average comes down to the 50-day moving average, that coincides with the 10-day moving average moving up to the 50-day moving average on the SPY. All that works out, all that makes sense. And I've mentioned numerous times in the past that there are these correlations that exist in the market, and things can get discombobulated, is my word, at times, but usually the correlations, the long-standing historical correlations, come back into being, and that's one of them. And so we'll see if that plays out. It doesn't always work that way, at least in the short term. In the longer term, it usually does, but not necessarily in the short term. So we'll see how things play out over the next few trading days. But if I look at gold through the GLD, down today with the dollar moving to the downside. So we were speculating that a weaker dollar or the dollar making a pullback could put a bid into the metals. It didn't do it today. And if we look at the moving averages, you can see that we're still significantly oversold. We actually had a down day in GLD. Makes me wonder if the Federal Reserve is in there and they're just hell-bent on keeping gold down, and they do a pretty good job of it. That's just, I know it's a bit on the conspiracy theory side, but I also know a lot about the Federal Reserve, and I know they short gold. They don't want gold to become, they're concerned about Bitcoin now, but they don't want gold to become to the point where we start talking about having a currency pegged back to gold again. this gives them free run, getting rid of that pegging as far as manipulating money. So the Federal Reserve does not want the currency tagged to anything. So when we're looking at 170, that's a point where gold needs to really hold. If it doesn't, then we're very likely coming down here to 165. There's all kind of support in between 160 and 170, or excuse me, 165 and 170. But I feel like the likelihood is if we can't hold 170 here, we tried to yesterday, got back above it, but now we're back close below it again. We probably come down and test 165 on the low before we move back to the upside. So we'll just have to wait and see how that all plays out. All right, so let's take a look at some international markets. And for those of you viewing on the live streaming services or our longtime subscribers, please don't tune out when we start looking at international markets. All these securities that I'm going to show you are tradable on the U.S. exchange. Some have really good patterns. And so it makes sense to watch. And I say that because of comments that have come in. Some of you really want to look at the international markets, and some of you have no interest in looking at the international markets. So, you know, we try to do the best we can to please the masses. But in general terms, that's a difficult thing. All right. Well, actually, I'm going to backtrack on that. I'm going to show you some other U.S. markets before I go ahead and show you the international markets. So here's the Dow on the DIA, and notice the Dragonfly Doji there to the upside. So does that mean potentially more to the upside? Possibly. We look at the DMI and it's kind of neutral. Not a whole lot going on there. We got in the 10-day moving average, back above the 10-day moving average. So perhaps we make a run up towards this 330 level. Remember, the Dow was the last one to break its support level at 330 there. And it's quickly coming back up to test that level. And I've commented on the speed of the move being significant before. You can see we're almost back to 330, but we're nowhere near the 10-day moving average back to the 50-day. So the Dow looks a little bit more like it could break back above 330 on this bounce move before creating its wave 4. Note that the wave 4 is a little bit above that support level of 330, and we go back and look at the SPY and note the wave 4 projection is right around 420. So right now from the projections, it's showing the potential for a little bit of a bigger bounce out of the diamonds. Isn't that interesting? I mean, all this kind of stuff, you know, the Elliott Fibonacci stuff, and the software program called Profit Source, which to me is the best Elliott software program out there. The reason I say that is, one, I've used all the ones that I know that exist, and this one's programmed directly from the mathematical algorithm that Ralph Nelson Elliott wrote. So those things are important to me. I guess everybody has to see what's important to them, but to see the fact that we have separation here with the Dow being the last to break support and perhaps moving further above is quite interesting. Now the Qs were the leaders on the way down, so it makes sense that they'll be the leaders on the way back to the upside. And look at that pattern. I had mentioned to you numerous times it was one of the most solid LA wave patterns you could expect to see, and we're right down here. Look where we went to. We were talking about this last week. Could the Qs go down to 100% extension? Look where they went. Dead spot on. I mean, this is, you could write a textbook on Elliott wave Fibonacci from this pattern, because the wave 4 retraced or corrected to the 61.8% fib level. And when you have a correction to the 61.8% fib level, you're looking for a 100% extension in the 5 wave following the wave 4 correction. It's exactly what happened in both cases. If you've watched any of these videos, you heard me saying that this is as good as it gets in the LA wave world as far as this pattern, and has come out to be absolutely dead spot on. The only question that's left now is that it? Is the wave 5 going to end at the 100% extension, or are we bouncing back? And in this case, the support resistance level is 320 on the Qs. Are we going to bounce back up there and then go make a new low and likely go to 161.8% extension on the wave 5? I think that's likely. Anything can play out. You know, we'll reevaluate when all of these markets make it back up to their support resistance levels, which that is likely that they all do that. And then we get this 10-day back to the 50-day where it should be. and then we'll reevaluate and see where things go from there. But for the fact that this wave 5 went exactly 100% when we had a 61.8% wave 4, man, it's just, that's why we look at Elliott wave, and that's why we look at Elliott wave with Fibonacci levels, and that's why Elliott incorporated Fibonacci levels into his wave theory. That's it. Doesn't get any better than that. There's your commercial testimonial for Elliott wave right there. So all the haters out there, anti-Elliott wave people, explain that. It's not explainable other than this stuff works. All right, so looking at the IWM, there's a bit of a bounce here down to 170, and we are looking for a bounce back to 190 now. The IWM is very similar to the Dow in the fact that the wave 4 potential forecast would show a break back above 190. Now, all this kind of makes sense too, as well, doesn't it? From a psychological standpoint, we don't talk a lot about fundamentals. We don't talk a lot about psychology. We talk mostly about technicals, but everything all plays into it. When you think about if we have the diamonds, the Dow, and we have the IWM, both breaking above resistance levels and both breaking above them, to a point where people could feel like, everything's okay now. We're back above support resistance. We're back running to the upside. And then that's when things turn and we make the actual low that occurs. I'm still of the belief that we need that cathartic downward day with a big spike in the VIX. And if you watch the video from last week, you saw the analogy of the boxer where the VIX is just beating the market to death with a higher VIX without being a real spike in the VIX, puncher versus boxer mentality. We'll find out. My opinions are really just that, nothing but opinions. I do have some experience, but in the end, the charts speak for themselves, and the market's going to tell us what it's going to do. The charts are how we read that. My opinion is meaningless, is what I'm trying to say. So right here, you can see that there's a lot of congestion right through that wave 4, right at 200. So perhaps the IWM is able to make it back above 190, get back in that trading range between 190 and 210, but then possibly fail right around 200. That could all play out. We'll have to wait and see. All right, so Bitcoin's bloodbath that it was having, and a little bit of a reprieve from there as well. And you can see that awfully darn close to that 24,000 level, a little bit of a bounce back to the upside. You look at the moving averages. Now, the issue with Bitcoin is even with this little bit of a bounce, it hasn't even recovered its 10-day moving average yet. So it's nice to see it trading back to 30,000, but we need to see Bitcoin come up and test 36,000, and look where that is, right smack in the middle of that wave 4. So you're starting to see all these things line up as far as how far this bounce could go, and then we'll just have to reevaluate when everything gets there. Can we bounce further from here, or is that it? We'll wait and see how this all plays out. But I think Bitcoin tries 36,000 out of this bounce, and then we'll see. But there's a bit of a doji here, and I know all the 24/7 Bitcoin people don't like to look at the daily charts as much, but it matters. So we have the print for end of day, even though it's still trading 24/7, and I think that kind of stuff really matters. So we'll see if it jumps back up to 36,000 is going to be the key there on Bitcoin. So looking at some of the other markets, the EWA, I know a lot of you have asked about that for the Aussie market due to the fact that it can, it's a little more tradable, and you can see the bounce back to the upside here, a bit of a doji, but this was the key. We talked about this over the weekend last week, and you can see this doji here down around this level below 23, moving back to the upside. So can we move back up? And a lot of indecision here in the Aussie market based on these dojis, but we're right here at resistance there at 24, and then there's a separation between the 10 and the 50 there. So the question would become, how far do we move to the upside? We had this 121% wave 5 here, and we've already recovered that. So we made it back to the previous 4. All that stuff's done. So there is no current 5-wave impulse pattern on the EWA. We're in corrective mode here. And so we're looking to see how far things go. Now, the question I have is, could this be a big zigzag pattern right here, and that we're working our way up to, potential B wave with more lows to come? I think we could be. We'll have to wait and see how it all plays out. But the fact that we've moved back above 24, I think, is key on the EWA, and where the 50-day moving average suggests that perhaps we test this next little area of support resistance up at 25 on the EWA, and then we find out where things go from there. INDA for India, and if I leave a market out because we're trying to just show a lot of different things in those recordings that we do on the weekend without giving you another hour-long webinar on the updates, somebody's always looking for what's left out. So we left out India the week before, trying to show other things, and then last week I left out the DAX, and so people are like, "Where's the DAX?" I'm glad that everybody's used to looking to see their favorite markets, but if we show everything every time, these will be hour-long videos, and we're trying to be respectful of everybody's time. So look on the INDA here, where we had 129% wave 5 extension. So that means we're looking for a 61.8% correction, and we went past that, as we noted last week. So we hit it past that, almost a 78.6, and now we're back down here testing the lows. So nice bounce back to the upside from a very oversold condition based on the 10-day moving average, and there we are right on the 10-day moving average. Now we have some separation here between the 10 and the 50-day on the INDA as well, but not quite as severe, almost, but not quite as severe as it is on the SPY. But I would say that there is a chance that we bounce all the way back up here to 44 on the INDA. I think that's a likely scenario before the potential bounds can be considered to be running out of gas. And then the DAX, and same chart, almost identical to the INDA, with the gap up today from these oversold conditions. Both of them were testing lows, and then both of them had big gaps today, back above the 10-day moving average and nearing the 50-day. So for the DAX, it's got to show us that it can get back above 27. And if it does, then perhaps we start looking at a big zigzag there as well, where this is the A wave to the downside in the wave 5, and then we have a big corrective wave. And I get comments on YouTube all the time of, a zigzag is a corrective pattern. You can't have a corrective pattern in an impulse pattern. Yeah, you can. That's what Elliott wave is. Elliott wave is impulses and corrections. The waves within Elliott wave don't go in mono waves. That's why there's corrective waves within Elliott wave, complex waves. A complex wave is simply a wave that has a corrective pattern within it. It's purely part of Elliott wave. So if you're saying that you can't have a corrective wave within an impulse pattern, you need to go to our website and look at our education, because we've got tremendous education there. Elliott wave is far more complex than a lot of people think it is. And I'm always frustrated by people that try to plot Elliott wave by hand without using software. And the reason that I say that is not pushing software. It's because the mathematical algorithm is like 30 pages long. And I just don't feel like the average person's brain can process what it takes 30 pages of code with data coming in to process and plot these patterns on a chart. If you can, great. More power to you, but I haven't met the person that has been super accurate by doing it by hand. I've met a lot of people that felt like they could, but I haven't met the person that really was adept at it. I think software is crucial when you're dealing with Elliott wave. This goes back to one of my saying, nothing worth having in life comes easy. I know not everybody believes that. I do, and I believe it's because we need to appreciate things that we work for, that we strive for, our achievements. And if everything came super easy, we wouldn't appreciate it as much. So we go through bad times so we can appreciate the good times. We work hard so that we can appreciate our achievements when we achieve things from working hard. And if your life was just about everything coming easy to you, I just, that's entitlement, and that's not something that I'm interested in. So those are my personal beliefs, and whatever it's worth. But Elliott Wave is not simple. It's not easy. That much I can tell you. I've been trading it since 2001. And so that's a long time. So over 20 years of trading Elliott Wave, learned an awful lot, and still learning every single day. That's why I like the markets. Every day you learn something. All right, so back to the DAX, get above 27. We'll see how far that can go, perhaps 28. But that wave 4 at 50%, I would be surprised if that gets taken out, even though it could go up to 61.8%. I don't know that that really happens here. We'll see. I'm going to go ahead and show you the VIX before we get into what else I wanted to share with you tonight. So there's the VIX moving to the downside. And this is that just badgering of the 35 level where we have significant resistance there. And I feel like there could be a little bit of a relief. We called this a relief rally that was due in the markets, and that's what's occurring. So perhaps the VIX comes all the way back down towards 20. There's going to be support there that's held. As you can see, the last 2 times we've come down, actually the 3rd time going back to February. So perhaps the VIX makes it back down to 20 again. And there's the 10-day moving back down to the 50-day, a lot quicker on the VIX than it is on the markets. But, we'll see. Is that enough? Is that enough badgering of the markets with extra volatility to put a bottom in? Does it feel like it bottoms into you? It just doesn't to me. And that may be the number one reason why it could be, is because it doesn't feel like it is. We'll see how that plays out. Now, I talked in the beginning about the difference between these case study considerations that we identified during TradeFinder versus the alert service that we have for our subscribers at EWOTrader.com, where here, when we look for case study considerations, we leave it to you. We say, hey, consider this, and then you're on your own with what you do. In our alert service, we take you by hand from start to finish, from opening a position, any adjustments, and then through the closing of the position. So what I wanted to share with you tonight is an adjustment that I made today on USO. So this was not a closing position, but this was an adjustment. So if you take a look at the chart, and this is why I didn't show you oil before, because I knew I was going to show you that here, you can see there was a pretty nicely formed symmetrical triangle on oil. So that initiated our strangle position because of that triangle pattern. Well, here's the adjustment that we made today, where we actually rolled this position out to give it more time. Now, from that original triangle, we had a break to the downside, we had a break to the upside, we came back down. You can get a false breakout in one direction, but you don't get false breakouts in 2 directions out of these triangle patterns. When you have what looks to be a false breakout one way and the other way, it's telling you a larger triangle is forming. And you can see what happened here is the fact that we are forming now a large ascending triangle. You can clearly see the pattern of higher lows there and the resistance that's occurring around the highs. So what was a symmetrical triangle has morphed into an ascending triangle. It doesn't do that all the time. It happens. It's, I don't want to say rare, but it's a smaller percentage of the time than just a pure breakout, which is what occurs most of the time. So because of the fact that we now have an ascending triangle versus a symmetrical triangle that looked like maybe it was trying to break out, we didn't want to be directional. And with the original position, you're kind of directional then to the upside. So reset the deltas, move the position further out in time. So you reset to delta neutral in what's now an ascending triangle, and look at where the ADX is. It's low down there around 10. So our subscribers that come in from level 1 with the time strategy have access to the volatility strategy as well for a period of time due to the fact that we haven't had a ton of these strangles with the VIX being so high. The options are just too expensive. We get the VIX back down towards 20, all of a sudden you're going to see a whole bunch of these strangles come back out again. But you have to be careful when the options get too high. So we're down 27% right now on the original position, and that's because of time decay. That's what happens when you have a strangle. You're buying a call and you're buying a put. It hasn't really broken out significantly yet, but we've reset the deltas. And with a larger triangle, what usually happens is the breakout becomes more volatile. You get a bigger breakout, and then that will recover the loss, and we'll still end up with a profitable position. So still feel really good about it. And I've got a sneaky suspicion, again, this is just going back to a feeling and nothing more than that, that oil could surprise us. You know, we talked about how, and I was involved in this conversation as well, that it was hard to come up with a scenario where oil broke lower. And when you see an ascending triangle, we've talked about this before as well, there's a lot of marketing out there. This is an ascending triangle. I was just reading something last week, and it just makes me cringe every time I read that. But an ascending triangle does not mean you're breaking to the upside. A descending triangle does not mean you're breaking to the downside. Most everybody realizes that a symmetrical triangle means you could break either way. I'm telling you, the data does not support the upside or downside scenarios. I've looked at it extensively, and so it's telling you it can break either of those triangles. Ascending, symmetrical, descending can break either direction. And I just got a feeling that with everybody looking for it breaking higher, which would be horrendous if you go to the gas pumps. If you're using premium gas in Florida, it's $5.20 a gallon, and that's not even the highest premium. You know, if you have it broken between 87, 89, 91, and 93, my car uses 91, $5.20 a gallon today. Just insane. But anyway, I don't know. I think that something could happen, that oil may surprise and break to the downside, which could further in the relief rally. I don't know. We'll see. Maybe it breaks to the upside, and a month from now, we're talking about $6 a gallon gas. Who knows? The market's going to do what the market's going to do. The feelings are just feelings, and that's it. All right, so let's go back and look at some of our case study considerations that we looked at in past trade finders. Here's Smucker, and this was back on 419. We put the Elliott wave pattern on. It wasn't in one then. It is now, and you can see that big tail all the way down to test support at 140. Isn't it amazing how volatile jelly is on a daily basis? I know it's a lot more than that, but with these intraday bars, it blows me away how volatile it is on an intraday basis. So here we are right back up here, little bit of a triangle being formed here, tried to break to the downside and came right back up into that triangle. Remember, Elliott always said, don't forget the smaller triangles. So I don't see any change potentially in that one. Canada, that was the original look. And then we had the breakdown, and we talked about how I was surprised that Canada broke below 36. I really was. I just felt like that would hold, and it went right through it. But look, we're already back above it with a pretty vertical move there in the Canadian market. So if you were following that one and you didn't close it out, you know, if it can bring it back above 37, then we could be back in business here with Canada. But we have that potential wave 4 there, and we have just as good a separation between the 10 and the 50 as we do in the US there. So perhaps 37 is it on the bounce. So if you were following this and you didn't get out, you know, maybe this is a good time to go ahead and do that. And then on May 3rd, we looked at Reliance Steel, and nice bounce back to the upside today. You can see coming back. So some of the metals did okay with the falling dollar, just gold didn't, which is interesting. And then we looked last week at WLK as a potential moving down to 110, and it's bounced with the market moving back to the upside, with the 10 being curling back to the upside. We're right smack in the middle of this tap box at the 61.8% level. So if you're following the letter of the law with Fibonacci and Elliott wave. If we break above this wave 5 and we make a new wave 5, that would be your exit. In the meantime, you could stay in. But if the market's going to bounce, it does appear that this wants to bounce with it. So stay with that or not. That would be interesting. And then HZO, you can see here kind of gone sideways since we looked at that one last week. Nice move to the upside today, but really haven't gone up or down. But some pretty good consolidation here, and it needs to break above 45. So good consolidation right below 45 could be setting it up, because if it can get back above 45, then it's watch out to the upside, because we had this big move lower here. There's not going to be a lot of resistance on the way back up. There is a lot of resistance at 45, so that makes sense. So as it's churning here, if it can get back above 45, not only do we go back to this previous floor at 50, which was our original plan, if you remember from last week, but likely that we could go all the way up to 60 and retrace the entire impulse. But we got to get above 45 before we can even talk about getting above 50. So that's where we are looking at that. So that's it. There's just not a whole lot of case study considerations that would still be open. We've closed so many of them. As you know, we look at one each and every week. So let's see what we can find tonight and see if there's anything that looks interesting to continue with this bounce. There are 4 impulse stocks, and I don't look at these ahead of time due to the fact that I don't think that that's, I shouldn't say that's not fair, but when we're doing these, we're trying to make these educational events. And if I've already pre-looked at everything and have everything set, that's just regurgitating information to you. But if we talk through these with the charts and whether or not that would be something that we're interested in, I feel like you get a clearer picture of the process of selecting a trade. And that's pure and that's more educational than me just regurgitating information to you. So I hope you feel that way. And here's CI, and we already have this as an alert for our subscribers. It was on the new 52-week high list today. And so let's take all this stuff off. And the ADX is curling back to the upside. You can see the good separation between the positive and negative directional indicators. I would have preferred if we got a little further below 20 to curl back up, but we did break 20 a little bit and are turning back to the upside at 153% extension. So that's probably going to 161.8. And you can see that new closing high today as well. So not just a new intraday high, new closing high on Cigna. So if we go to 161.8, is that enough? Is that enough to put on another position? As I said, we already have this alert for our alert subscribers at EWOtrader.com. So perhaps we can find one of these other ones that looks a little bit better for the bounce that's not already as mature. And if we take a look at EXPD, Expeditors, it looks pretty interesting to me. See that? Yeah, that's a much better looking. I really like this one, actually. Well, there's a problem. Right, so here's the interesting thing. This is why we have our confirming indicators to go along with Elliott wave. The DMI looks about as strong as it could get for a potential move higher. We had an update today, and the positive directional indicator moved up and the negative went down. So it was new buyers, fewer sellers. The ADX is moving up, showing strength to the move. Now, the key is it's in a wave 4 corrective move, and it's at 50%. So is that going to be where it runs into a wall there? The DMI suggests no, there's more upside to go. But a 50% wave 4 correction suggests that we could sit here for a while it figures out if it has enough strength to go up to 61.8. The next support resistance level is all the way up at 130. There's really not a whole lot other than where we are right now. There's a little bit of a dip you can see here back from October of last year that happens to coincide with exactly where we are. So you can look at this and say, well, was that the test of that on the 13th and then back down and now we're back up? Could be. You know, Friday we hit that level, bounced back, held the 10-day moving average back up here today. So we could move that wave 4 higher. We could disqualify the pattern. All those things are possible, and our confirming indicators would suggest that, yeah, this Elliott wave pattern could become disqualified. But man, this having a 50% wave 4 correction, I would want to see that get broken first. So my viewpoint on this is if we can make it above where we are now, because not just of that 50% wave 4 correction, but the fact that it was support resistance going back to October, if we can break above where we are now, I think it goes to 130. So I would put a contingency on this one, that if we can break higher, let's say we break to 120, if we can break to 120, I think it goes to 130, and then it becomes a really good trade. I think that's highly likely. But in the consideration of caution, I think we need to see that first. So let's see what else we have. Boise Cascade, see what that looks like. Man, this has got a lot of work to do, doesn't it? It's got to get above this area here at 82.5, 83. It's got to break that. It's got to get above 85. We need to get up there to 85 and break that wave 5. If we do, we could be off to the races. But I think this is too early, and the ADX is not turning up enough, and the ADX is not above 20. On our confirming indicators, I have it set above 15 so that I can watch these. So some of these come on a watch list that haven't actually triggered yet. This is not triggered yet, so we wouldn't do this one anyway. But can you imagine the scenario here if the stock can get above, can get up to 85, and that ADX breaks above 20 while these two directional indicators are separating? So they separate, the ADX breaks above 20, we break above resistance here. Man, that could be, you got to put that on your watch list. So, watch list has to be Boise Cascade. So the symbol there is BCC. If you're having trouble seeing it, that is a definite watch list. It's on mine. That's why I like to set the confirming indicators ahead of time so that we can keep an eye on things like this. All right, so now let's go back and see what Builders First Source. Oh, man. I don't know what that is. It sounds like a bank, some sort of financing for builders. And from a fundamental standpoint, with interest rates going up, that seems questionable, but maybe that's not what it is. Maybe it's something totally different. Not really familiar with this symbol. Doji today, yikes. Tombstone Doji. So you see this here with, Dragonfly Doji. So at least that's better. So break above 70. There's resistance at 75. The DMI looks really good. The ADX is breaking above 20, and we're starting to separate here. So I really don't know if this is some sort of funding. Maybe that's the reason that it looks better. I just think construction is probably going to struggle now, but I don't think financial companies are going to struggle. I think they're really excited about where things are going in the rest of the year. But I would want to see it break above 70 first. So with that, we go back, and I think that the best looking chart on here, with the fact that several of the other ones are, really potential watch list candidates, that the best one for tonight is Cigna. And as I said, we already have that as a subscriber for our alert subscribers, and we'll see how far this can go with this. The DMI is suggestive that we could make a very nice move, and we're getting some confirmation from the other indicators. We're not at an extreme point yet in the CCI. Perhaps we only get a $10 or $15 move out of this. That might be the end of it, but that's, I think, with all things considered, that's the best looking chart. Now, looking at the 10-day moving average, don't get taken back if we open lower on Cigna tomorrow, because with that breaking close to a new high, it's going to be all over the news. New closing high. Some people use that as a short signal. It has a little separation from the 10-day moving average. So actually, it would be good if maybe it didn't blast off in the morning and pulled back a bit and gave a little bit better entry, that would be a good thing. But I think that that's where we need to be. All right, so those are the things I wanted to share with you. And Zach, we'll go ahead and open it up to questions.
Awesome. Sounds great. We've had tons of great questions and comments coming in from both Zoom and YouTube. So we'll pass through as many as we can with the remaining time.
Sounds good.
First up, we'll have Jess from YouTube. It says, Rob, do you think China preparing to open back up will assist the market upward?
There was a lot of upgrades of the China stocks today. So I do think that it's going to be helpful. Let's look at the FXI. And, there was a pretty decent bounce in a lot of the China names today. Alibaba, NIO, the typical players had a nice bid today. And the question becomes, how long will that last? Because being shut down, yeah, it's great that they're opening, but that the earnings aren't going to be good for a while, right? Because they got to get going again. And that's why you look at the FXI and it's still in a wave 5 to the downside. So nice bounce today, nice move back to the upside on the news. But for me, it's got to get back above the 50-day moving average, and the 10-day moving average has to get back above the 50-day moving average. And then lastly, I would want to see the stock break above that wave 4 high. All those before I went long China, but that wasn't the question. The question was, can that be helpful to the market? Yes, if some of these stocks catch a bid, because the Chinese government does seem to be backing off a little bit. There's less talk of delistings and all those kinds of things. So yes, that could be helpful and supportive of the market, but just on this relief rally that we're talking about here, not long-term yet.
Very well. Thanks for that, Rob. Next up, we'll have John from Zoom. Would like to look at a couple symbols here. First one's going to be TA.
Ta, common expression down under. I see enough of these places when I'm driving. It's hard for me to imagine with the number of people that are in these travel centers. It's hard to imagine the fact that it's going down like this. That's kind of surprising because they seem to do a great business. But down here around 35 is support, so that's key. But we're only at a 46% extension, and we move past the 38.2% level on the wave 4, so that's concerning. The fact that it could very well go down to a 61.8% wave 5 extension, which is where it's supposed to go. So it could be that we're just building some support here. Now we are right on the 10-day moving average, but for me to consider being long this stock, it would have to break back above 40. If it did, then it would be interesting. But I think there's still too much risk that it breaks below 35 in the meantime. So for me, it would be, if it can break above 40, yeah, I'd be really interested in it, but it's got to do that first. Still have concerns, as I said, about breaking below 35. But yeah, see, that's why the fundamentals become challenging, because these places are slammed with people. Anyway, next one, Zach.
Next one's going to be NTR.
Nutrien, pretty nice bounce off that 38.2% wave 4 corrective move. Nice little doji there, moving back to the upside. Let's see what that looks really good. This chart looks good. There's a positive cross between the two directional indicators. A little disappointed the ADX. Remember, the ADX is a bit lagging, but a little disappointed that it didn't give some sort of a nod to that upward move. But without the DMI, we can look, the CCI looks really good. Money flow is okay. So perhaps money flow comes back in. I think that the 10-day came right down, kissed the 50-day. So it's satisfied its condition of being overbought. So there's that separation you hear me talking about all the time between the 10 and the 50. There's what happens. The 10-day moving average came back to the 50. So it's done it. It's ahead of the markets. So could it lead to the upward? I like that chart. I think there's a great chance it goes up to that wave 5 target. If you wanted to be super ultra conservative, you'd wait for it to break above this area here, right around 112. Or if you want to be a little bit more aggressive, I think you could take a shot at that now. And I say more aggressive due to the fact that the DMI is not confirming the move yet, but it held the 50-day really well. I think that one, I think that looks a good one. Looks like a good one in this potential relief bounce that we're into the market. I like that one.
Agreed, and good find, John. Next up, we'll go back over to YouTube. There actually were a few comments on this. Did we cover the Qs?
We did.
There was just some chatter around where the overall Qs might end up here.
Yeah, they may have come in early. I talked about, or maybe these people just showed up later, but I talked about where we hit 100% extension spot on after a 61.8% level. So, I mean, exactly 100%. So where do we go from here? Well, the next stop is testing resistance at 320. Then we have to wait and see from there. So there's a quick recap of it. But yeah, I talked about the Qs.
Thanks for that. Apologies on missing that one there.
No worries. Maybe they came in after I talked about it.
All righty. So next up, we will go to Will from YouTube. Rob, if time allows, I'd like to look at CCJ, which is in the uranium industry.
Yeah, you know, that was on my search list. I was looking at that today myself. It was on not the impulse search, because you can see it's not in an impulse pattern, but it's on a different search that I have, more of a momentum type search. And I think this is super interesting. So I find that interesting that you would ask about this when I literally was looking at this chart earlier today. So I think there's a great chance that we bounce here. You know, you look at the DMI, but remember the DMI is lagging, it's not leading. You look at the CCI, looks really good, and you're starting to get a positive slope. Now remember, with the CMF, it's not as simple as being green is good, red is bad. It doesn't work that way. You're looking for a convergence divergence out of the CMF, and the fact that it's moving to the upside and is sloping up, even though it's still red, that's positive confirmation. So confusing to people that aren't really familiar with how the Chaikin money flow works. I find this one really, really interesting. And I feel like that some of the move could be missed if we wait for the DMI to fall in line with the rest of it. And if the dollar is going to weaken a bit, yeah, I think this has a great chance of going up to 28. I like it myself. So yeah, I'm with you there.
All righty, thanks for that.
Not to mention one last thing, that it was grossly oversold. You see how far the 10-day moving average is from the 50-day. So maybe it doesn't hit that 28 target, but it likely hits 26.
And this goes back to the discussion we were having last week on PTGX, a similar situation. Mike has asked from Zoom, Netflix, close the trade versus accept the assignment, sell shares in the long strike.
Yeah, we're going to be talking about this for our alert subscribers. We're going to be going through this in detail because we have a few that have May expirations. So we'll be talking about that Thursday night. And yeah, same thing here on Netflix. Netflix, you know, I wish we had a little bit more time, because I think that one really has a great chance of bouncing all the way back up to 220. Whether or not it can do it before Friday is going to be key, right? Maybe not, or maybe it could do it in a day. So for now, yeah, I say we follow the same plan, accept assignment, sell the shares, sell the appropriate number of long options, and we're going to stay with this. You know, we'll see how strong the relief bounce gets, how fast it moves, but the possibility of getting back to the 220 level by Friday, it's not impossible. It would be a stretch, but it can happen. There's a big old huge separation between the 10 and the 50-day moving average there. So I have lots of confidence we see 220 again in the not too distant future. We'll just wait and see if we can see it by Friday.
Awesome. Thank you for that, Rob. Pabs from YouTube would like to look at Google.
Good old Goog. We haven't looked at Google in a while. So, you know, if we're going to have any sort of sustained relief bounce in the market, and I mean more than one day, if we're going to at least go up and test resistance, then I could easily see Google coming back up here, creating this wave 4. So testing what 25.20 and potentially creating the wave 4 there. So I think, yeah, I like the looks of Google for a bounce here. Again, significant separation between the 10 and the 50, massive support being built there at this level around 2280. So I like Google to move back to the upside towards that area there around 25.20. I think that's one of the better looking plays you can make right now. So good call on that one.
Yes, indeed. So David's got a couple symbols for you here. You already looked at FXI, so the other one is going to be SMH.
Semis, and I didn't look at those today. So let's see. They got a pretty nice bounce. Wave 5 hit exactly at that wave 5 target. Now the wave 4 was roughly a 61.8% correction, so could have expected that to go down to 100% just like the Qs did. Didn't quite make it. Perhaps it gets there eventually, but notice on the SMH, we're already back to resistance here. Remember where we showed you the potential bounce in a lot of the other markets? Well, the SMH, their support resistance is 240, and here we are already. So could the semis lead us out of this mess or lead us into this little bit of a relief rally? I think that's likely. So anyway, long-winded answer, as I always am, I would be really interested in the semis if we can break above 240, because I think right now all we've done is rectify the oversold condition, and it's already done where there's room to run in some other areas that you could take advantage of. But if it can break above 240 and then it becomes a market leader, then I think everything changes. If it can break above 240, it easily goes to 260. There's nothing to stop it between 240 and 260. So break above there, and yeah, we got something going. So very interesting looking chart, man. The viewers are picking some really good charts to look at. All right, let's do a couple more.
Definitely on it this evening. Yeah, I was going to say.
Yeah, they are. Yeah, really, really great looking charts.
Always happy.
Lots of fun. Yeah.
Yeah, it makes it enjoyable knowing that everyone's on the ball like that and tuned in. But yeah, I was going to say, just as always happy to stay on as long as you are. So a couple more, you said?
Yeah, let's do 2 more if we can. If there's any more YouTubes and Zoom, and do one of each if that works out or whatever.
Sounds great. Waka Waka from YouTube would like to look at Tesla. So that's always a fun one.
Yeah. Didn't do that one in the last update, so I'm sure everybody was curious about the bounce that occurred today. And then, you know, Elon starting to waffle again on Twitter. I think that Elon is very suspicious of the percentage of bots on Twitter, and he was told that it was 5% or less, and I don't think he believes it. That's just my assumption. And you know, it's going to cost him $1 billion to walk away, but you know, what's $1 billion when you have 200 billion? So but as far as Tesla, I would be curious to see if the Twitter deal dies, if it doesn't put a bid back under Tesla. Remember, we talked about this day right here when he sold all those shares to come up with his part of the financing, and the stock hasn't been able to recover. Now, is that just because the market tanked from there? But it was holding in a lot better earlier, where it was going dead sideways till he sold all those shares. And then the concern of, well, can he run? How many companies can he really run and run well? But the fact that it got back up to 760 today, the key is look at this separation here. It really appears that there's more of a bounce to come in Tesla. Looks like Tesla wants to go higher from here, but it's got to get above 760. And if it does, then I think there's follow through to it, maybe all the way back to 900 plus. But it just has to do that first. And Hadn't even made it back to the 10-day moving average yet. So today was a nice day out of Tesla, 5% move back higher. But it would be more impressive if it got back above 760, because I do think you could see something significant there. And this might be another, like the SMH could be another leader on the bounce back to the upside, especially if the mood is starting to become a bit more negative on Elon really doing the Twitter deal. We'll see. All right, the next one.
Just to add to that real quickly, I saw earlier that Twitter had reported that it was just under 20%. So there seems to be some flip-flop between what's actually
20%.
Just under. It was 19.7 something along those lines. So we'll see what the finalized number comes out to be.
I think Elon already suspected that, or perhaps he already had some advanced numbers of that, and that's where the wafflings come from. That's a different story when you're talking about 20% of your accounts aren't real. You can't monetize the bot. So yeah, it'll be interesting to see how that plays out. Thanks for sharing that.
It'll be $1 billion expense, but like you said, when you're over 250 bill, what's one out of that? So
yeah.
All right, so we'll do this last one here. Is a good question from Zoom from Tom. In your book, you wrote some time ago, you say that the 30 delta is the best bang for your buck when buying options. Do you still hold that view?
I do. Yeah, the sweet spot is right between 25 and 30. And I will say this, that the market is onto us a little bit by moving, because been talking about it. The book's been out a while and talked about it for a very long time. We talked to a lot of people. We're on YouTube. We've been spreading the message, and there's a lot of people now. If you look at the open interest, there's far more open interest at the 25 to 30 delta than there used to be. So I still maintain that's the place to be as far as the math, because the math doesn't lie. That's where the fastest speed of delta is due to the gamma. That's where the options are going to gain value the fastest when you're right on a directional move. That doesn't change. What has changed is the market makers are now playing with the IV a little bit down there where they never used to. They kind of stayed more at the money options, and you didn't see that as much. So I would say that I still big believer in the 25 to 30 delta, but make sure you pay attention to the IV. And as long as there's no games there, great, good to go. I still think it's the place to be. I'm just saying that it just adds in that understanding implied volatility. For those that aren't familiar, we have an option accelerator class for our new subscribers at Elliott Wave Options, and it goes into things like that, talking about implied volatility, the Greeks, etc. So it's a great place to understand that a little bit more. But yeah, I mean, thanks for bringing up the book and talking about that, and and give me a chance to expand on that. Appreciate that question. All right, thanks everybody. Thanks for your time as always. As I say, time's the most valuable asset we all have. I'm a big believer in this. This isn't just blowing BS. We very much appreciate the time you spend with us, and we do our best to make this an informative and educational use of your time. Very much appreciate it. Thanks. Have a great